Hi, everybody, and welcome to this week's Middle Class Investor. This is Seth Martin, your host, and we got a picture of the S&P 500 up here on the screen. And as you can see, we never did make it down to this little support area. Now, I've mentioned this before on this program, but these are arbitrary. So just because it didn't go all the way down there doesn't mean something's wrong. I mean, these are just guess areas. You can see here it went further than the guess area. So it just depends. The noise you hear in the background is thunder. So if I lose connection, I guess I'll just have to cut it short or start over depending on how far we are into the program. But the expectation is that over the next couple, maybe 3 weeks at the most, we run into this area. I'd say 2 weeks probably, next week and the week after. And then we should start coming back down, like so. And that's what I'm expecting to happen. This whole thing will be 4. We're waiting. This would be D up here, and then E of 4, and then a final 5-wave move up. If you want to get a better look at this, let's go back 20 years. And you can see the full 5 waves here. 1, ABC, 2, 3 to here. This is all 4, and then 5. So initially we thought this was 4, and then this was 5. But this pattern that we got going on here, this sideways pattern, looks to be a 4. So that would make this also a 4, but of the wave 3. So of this 1, 2, 3, 4, 5. This being all 3 from here to here, and then 1, 2. Or 1, ABC, 2 to here. Probably what I need to do is label this just so everybody can get a better understanding of it. And I probably need to redo these too, because normally what you do is you connect. Take this one off too. You connect the bottom of wave 2 and the bottom of wave 4. So let's just do that real quick. Here's the bottom of wave 2 right here. Here's the bottom of wave 4 right here, and then we go up to the top of wave 3, which is right there. And so we're expecting this to pull back. I guess it's going to break this channel a little bit and then rally all the way back up here, probably to around this 3,400 area before we see the end of this intermediate wave move. And that's going to take a while. That's going to take a year and a half, 2 years probably. So might as well sit back, look to buy when we get down in this area. Look to we'll redraw this channel at that time too, because 4 will actually end up. In fact, let's just try to estimate where 4 will be, because this is a little misleading the way I have it drawn there. Let's say 4 goes to there. And the top of wave 3 is there. So our channel's there. So, D, E, and then 5, probably around this 3,400 area before this whole pattern ends. So, like I said, that's going to take a while. And so sit back, relax. Maybe take some money off the table now, wait till we get this pullback, and then put a little bit more money on the table for wave 5 for your 401k. I think that's probably prudent. Let's look at volatility. The VIX. I always have trouble finding the VIX in my list. It's something about the way they label it. There it is. Okay. So we had a little retraction of volatility last week, which makes sense because the market was up. Let's go back to the weekly, because I may be telling you an untruth. Yeah, so volatility pulled back a little bit, not much. I suspect it's going to stay in this range until we get a decent sell-off. Let's look at the 10-year Treasury. 10-year Treasury continues to pull back. We've got our zone here. I'm expecting it to pull back into that zone and then rally from there. I do not think at this point that we'll make a new low. We could, but I don't think so. So we're getting close. It's probably going to pull back a little bit more. We're getting close to that point where if you've got bonds, you should probably take some money off the table. Of course, I've been saying that, and everybody knows that listens to this. It's your money. You get to decide. But this is a logical support area. Now, if it breaks through here down into this area, then it's going all the way back down to a new low. But I don't think there's any reason to suggest that we'll make a new low at this point. Now, this tells me, and we've talked about this before, but this tells me the Fed is going to start lowering rates again. When the short-term Treasury starts pulling back, the Fed is not going to be far behind. So look for that to happen. I guess they just had a rate decision, so they're going to probably be 2 more months before we get a new rate decision. Let's look at Germany. Germany looks like it's pulled back to the channel. It's bounced and it's rallying. You might be wondering, well, how do you get into a trade like this? What's a safe way to get into a trade like this if you're in Germany and you're wanting to trade that? Well, there's something called a flag pattern, and basically all it is just you're basically waiting to break out of this downtrend, and of course you can see that happen there. So you could get in there, or you could get in on the next bar and rally up, and I would say you're probably good to at least here. So the previous swing high is right here, so the market will probably move to here, pull back a little bit, and then rally up, and then, man, if it keeps going, it could go all the way up here. But I don't know, these worldwide markets, I suspect they're all going to link up at once at some point. So we still got the UK is still kind of below the channel line. Japan was still below the channel line. These UK and Japan have some of the worst financial situations. UK has a lot of debt. There's a lot of concern about their economy because they're trying to break out of the euro. And I don't know. I think they're actually going to be better off, but that's me. I think Germany and Europe are going to suffer from that more than the UK is going to suffer from that. So, all right, let's go over to the TOS charts, and let's look at. Let's get off the ES. Let's look at gold. Gold has been really rallying, kind of according to what we were anticipating to happen. And we rallied right up into this support area. We're going to pull back a little bit, and I suspect make another high. We usually don't end on something like this. We usually get another pullback and then another rally. So I would say gold's not finished, but it could pull back a little bit. I mean, you can see how I have it drawn here. Didn't quite work out that way, but the idea is the same. You get a wave 3, get some sort of 4, and then rally into 5. Now 5 could be extended some. It's pretty common in commodities, but this is also a corrective move. We're still in, if this was A, I mean this is B, and then we're looking for a C. So corrective moves usually don't get an extended move and a corrected move. It's usually in an impulse move where you get an extension. You can see here's a wave 4, and this 5 is pretty long relative to the rest of this. So you can see that was extended quite a bit, and that's pretty common with commodities. Silver is following suit, but it's kind of a different pattern. It had a breakout, but hasn't really made new highs. But I suspect silver at some point will catch up, so keep an eye out for that. If we want to look at oil real quick, oil, as I mentioned, is probably in some sort of sideways pattern. So this is probably A, and then this is B, and maybe we're going to get some sort of C back down here to the trend line, and then after that it'll be a rally. So oil's just going to continue to trade sideways in this huge range. Now you could trade it in this range. I mean, from 75 to 40 or 35 it's a pretty good move in oil. It looks like maybe we might get down here to 35, so you can trade it back up to 70. That's a 100% gain. So as this narrows, though, the reward gets smaller and smaller. So just keep that in mind. Let's see. Is there anything else I want to talk about here? Yeah, the euro US dollar. It's right here. So likely this has begun to move out. For my shorter term entry, a lot of times I use a 4-hour chart. So let's look at this. And on the 4-hour chart, we're still in a decline. So it's possible this pulls back a little deeper, maybe even as far back here as 1.128 area. In fact, let's just draw that. And if it does, I would say that's probably going to be a good place to enter the market. So let's say from here to here, it pulls back into this area. Might be a good place to enter. So this could very well be an A, a B, and then we're in the beginnings of a where this is a 1, 2, 3, 3 to here, maybe 4, and then 5. So maybe something like that. Maybe we pull back into this 1.126 area, but then I think be a great place to enter. We talked about entering way back in here, and if you haven't done it, then you should get another chance right around this zone here. I think this is a really good opportunity, and I'll show you why. Ultimately, I think we're going to trade. I mean, short term, we'll trade back up here to 1.1 to 1.41, but ultimately, we're going to trade up here back to this new pivot high, or this old pivot high above 1.6. So I think the target, around this 2.6 area is going to be the place where you're going to look to hold. And if you do the reward to risk on that, you're talking about a pretty big reward to risk. I mean, maybe 15 to 1 kind of thing. So that's a good return to risk. So I think that's one of the best trades on the board right now. Certainly when the S&P 500 turns and we start to go down in wave E, there'll be a lot of good reward to risk on that, because for one thing, options will be fairly cheap right here. Options will be nice and cheap, so you can buy out of the money, say, the 270s on the SPY, 270 puts, and then they'll be deep in the money by the time you get here. You just want to make sure you buy, 3 or 4 months worth of time, probably maybe even 6 months worth of time, to give that plenty of time to get down here, although it'll probably go pretty fast. But you still want to buy more time, because you'd hate for it to get about here and then you start running out of time, and you left a lot of money on the table. So just to kind of give you an idea, when you're buying a put and you're buying 6 months worth of time, so 6 months would roughly be December. So let's look at the December, would be right here, and let's say you bought the 270. The 270 is going to cost you, well, right now it's pretty high. Maybe we don't buy that much time. Let's look at the October 100 days. Might not be enough time, but 270 is $3. I don't know why there's so much difference between the December and the October. 270 is like $3, so that's pretty good right there, pretty affordable. Maybe by the time it completes its move, the Decembers, a lot of money will have leaked out of those Decembers. And it's only 85 more days, but man, was that expensive. Let's see the October, December. I don't know. It's only, like I said, it's only 73 more days, 63 more days, but it's like 3 times as expensive, which is unusual. So I don't know. I'm not sure. I have to do a little bit more analysis on these options, but oh no, here we go. Maybe I was looking at December next year. Okay, so here's the 270 December, so it's 174 days, and you're talking about $5.20. So if you do the reward to risk on that, let's say, let's go back to the chart. So if we're paying for $5.70 option, and we're saying it's going to go to here ultimately, that means the 270 will have to be worth, let's see, 22.45. What is that? 22.40. Let me do the math, or I'm going to have to get a pencil because I don't have my calculator handy. But let's say 270 minus 2, let's just call it 220. That's $50. So you're talking about a $45 gain on. So if you bought one contract, it'd cost you $500, and you'd make, you're risking $500 to make $4,500. That's pretty good. So if you risk $1,000 to make $9, that's pretty good. So on and so forth. I would stick, and also I would stick with the. I mean, you could look at the DIA also instead of the S&P 500. If you look at the DIA, let's go to the chart and put in DIA. So you can, if you kind of do the same thing here, you're looking at the DIA going to 210. If you bought the 250, so let's see. Let's say you bought the, something's not right. What am I doing here? Oh yeah. If you bought the 250 and you traded it down to 210, same thing, $5. And if it went to 210, that'd be about $40, about $45. Yeah, so it's about the same trade at this point, which makes sense. The implied volatility is about the same, and so I don't know. Maybe the only other one maybe that might be better would be the QQQ, but we won't look at that. I'll let you look at that. Sometimes the spread on the DIA or the QQQ is not as good. So you can see here is about 25 cents on the SPY. The spread matters too, because that's money that you basically give the bookie. I can't remember what we were looking at here. We were looking at maybe the 270 maybe. I think it was the 270. So if you look at the spread here, see it's only about 9 cents, 8 cents. So sometimes the SPY is better just because it's not as thinly traded. It's traded more aggressively in larger lots. So I like the SPY, but sometimes the Dow can get moving quite a bit further on a relative basis. So you just have to weigh those different things and see what your preference is. All right, everybody. I guess that's about it for this week. There's really not much to cover. There's nothing really too crazy happening in the market. Not any more crazy than there ever, the stuff that usually goes on. But we do see this coming up into here and probably chopping a little bit and then rolling over. So that's the forecast as of right now. Of course, it could just go right through that. I mean, there's nothing guaranteeing that that's going to happen, but that's what we see so far. All right. Thanks a lot. Bye-bye.